Welcome to Easy Investing Strategies with Warren Buffett 10 time-tested rules. Are you aware that a staggering 80% of investors don't manage to outperform the market? However, there's one individual who consistently does. That's none other than Warren Buffett. Quite an intriguing fact, wouldn't you agree? The realm of investing is often cloaked in mystery, brimming with jargon that can daunt novices. Yet, amidst this intricate landscape, one man has persistently navigated the twists and turns to emerge victorious. This man is Warren Buffett. Known as the Oracle of Omaha, Buffett has become a symbol of successful investing, consistently outperforming the market for numerous decades. His strategy, frequently seen as unconventional, has proven to be a winning formula, generating substantial returns. What's his secret, you ask? Well, Buffett's success can be distilled into 10 fundamental principles he abides by. These principles have steered his investment choices, leading to his unmatched success in the stock market. Buffett, one of the most accomplished investors of all time, has 10 rules to his prosperity. Are you prepared to delve deeper? Buffett's first principle is that investing isn't a game. This concept is crucial to grasp as we explore the world of investing. It's not about taking a punt, throwing the dice, or hoping for the best. Investing is a serious endeavor that calls for careful consideration, analysis, and a profound understanding of the markets and their dynamics. View it this way: when you invest, you're risking your hard-earned cash. The choices you make can have real, lasting impacts on your financial future. This isn't a round of Monopoly where you can simply restart if things go south. It's real life, with real consequences. That's why it's essential to invest time in educating yourself, understanding the risks involved, and making informed decisions based on solid research and analysis. Investing isn't about luck, it's about knowledge, strategy, and discipline. So bear in mind, investing isn't merely a game, it's about making smart and informed decisions. Buffett's second principle, the Circle of Competence, encourages investors to stick to what they know. Now, what does the Circle of Competence imply? Well, it's pretty simple. It's all about understanding your areas of expertise and acknowledging what lies beyond your understanding. Visualize it as an actual circle. Inside, you have knowledge and industries you're familiar with. Outside, there's a vast world of unknowns. Now, it's not about never venturing outside this circle, but rather knowing when you are stepping into unfamiliar territory. Why is this crucial? It's because when you invest in something you comprehend, you have a better chance of making accurate predictions and assessments. It's like playing a game where you know the rules. You're less likely to make errors and more likely to win. Warren Buffett himself is known for investing in industries he grasps, like insurance and consumer goods. This principle has served him well, so remember, stick to what you know. It can pay dividends in the long run. Buffett's third principle revolves around Mr. Market. Now, who is this Mr. Market, you might wonder? Visualize him as a business partner who every day offers to buy your share of the business or sell you his. The catch? Mr. Market is emotionally unstable. One day he's wildly enthusiastic and offers you an exorbitant price for your shares. The next day, he's deeply pessimistic and wants to sell you his shares for a song. Buffett suggests that you should not be influenced by Mr. Market's daily fluctuations. Instead, consider him as a tool to serve you, not to instruct you. If the price he suggests is reasonable, go ahead and transact. If not, disregard him. The key is to make decisions based on the business's value and not Mr. Market's price. So remember, don't let Mr. Market dictate your investment choices. Utilize his mood swings to your advantage and stay firmly rooted in your understanding of a business's worth. Buffett's fourth principle is all about the margin of safety. Ever heard of a safety net? The margin of safety is just that, but for your investments. It's the difference between the intrinsic value of a stock and its market price. It's a safeguard, a cushion, and insurance against the unpredictable nature of the market. View it like this: if you're buying a house valued at $100,000 but you get it for $80,000, your margin of safety is 20%. That's quite a deal, wouldn't you agree? That's exactly how you should approach investing. It's about buying a dollar for 50 cents, a concept that not only minimizes risks, but also maximizes returns. Because when the market price eventually mirrors the intrinsic value, that's when you reap your profits. So, when you're about to make your next investment, ask yourself, what's my margin of safety here? Remember, always ensure a margin of safety in your investments. The remaining principles from Buffett involve patience, discipline, and more. As we delve further into the wisdom of Warren Buffett, we come across Principle 5. Be patient. Buffett once stated, The stock market is a device for transferring money from the impatient to the patient. Time is a friend of the good company but an enemy of the mediocre. So, it's not about timing the market, it's about time in the market. It's about letting compound interest work its magic over years, even decades. Moving on to Principle 6, Buffett advises us to exercise discipline. Investing isn't just about picking the right stocks, it's about managing your emotions. Fear and greed are potent forces that can lead investors astray. As Buffett stated, the most important quality for an investor is temperament, not intellect. So stay disciplined, stick to your plan, and don't let emotions cloud your judgment. Principle 7 is about understanding risk. The Oracle of Omaha encourages us to never invest in a business you cannot understand. This means that we should stick to our circle of competence and avoid jumping into investments we don't entirely comprehend. This principle aids us in avoiding unnecessary risks and potential losses. The 8th principle is avoid herd mentality. Buffett warns us not to buy a stock simply because everyone else is. He famously stated, "Be fearful when others are greedy and be greedy when others are fearful." This contrarian approach can be challenging to implement, but it can lead to significant rewards for those who dare to stand apart from the crowd. For Principle 9, Buffett advises us to build a concentrated portfolio. Rather than spreading investments too thinly across numerous stocks, Buffett recommends investing in a few great companies that you understand well and believe in for the long term. This approach requires diligent research and a solid understanding of each company in your portfolio. Finally, Principle 10 is ignore market forecasts. Buffett believes that short-term market forecasts are not only a waste of time but can be detrimental to sound investing. After all, nobody can predict the market's movements accurately and consistently. Instead, focus on the quality and value of the businesses you invest in. So, there we have it. 10. Safety, a buffer that protects you from the market's ups and downs. The other principles are equally important, each one guiding you on the path of prudent and profitable investing. Remember, the key to successful investing lies in understanding and following these time-tested principles. Happy investing.